What if the next financial collapse is not a sudden accident, but a slow-moving chain reaction already unfolding beneath the surface of the global economy, hidden behind rising markets and confident headlines? And what if the world's wealthiest investors are not chasing growth right now, but quietly preparing for a shift they have seen before in histories? The global economy today stands on a strange contradiction where debt is expanding faster than ever, while asset prices continue to rise as if risk no longer exists. History shows that whenever this imbalance reaches extreme levels, the system does not stabilize, but instead moves toward a breaking point. In 2007, financial markets were filled with optimism as housing prices surged and credit flowed easily through the system without resistance. Within a year, that confidence collapsed into the 2008 financial crisis, proving how quickly stability can turn into systemic failure. The pattern behind these collapses is not random or unpredictable, but follows a consistent economic structure driven by debt expansion and liquidity cycles. It begins quietly with growth and ends abruptly with contraction when the system can no longer support itself. Debt acts like an accelerator in the economy, pushing growth beyond natural limits by allowing future income to be spent in the present. However, when this acceleration continues unchecked, it creates pressure that eventually destabilizes the entire system. Central banks lower interest rates to encourage borrowing and stimulate economic activity during slowdowns or crises. Over time, this cheap money environment leads to excessive risk-taking and inflated asset valuations. As asset prices rise, they create the illusion of wealth and stability, encouraging even more borrowing across households, corporations, and governments. This creates a feedback loop where rising prices justify rising debt, and rising debt fuels even higher prices. The system becomes increasingly dependent on continued expansion, where growth is no longer organic but sustained by borrowing. At this stage, even a small disruption can trigger a much larger reaction. When interest rates begin to rise or liquidity tightens, the cost of servicing debt increases rapidly across the system. This exposes vulnerabilities that were hidden during the expansion phase. Confidence begins to weaken as investors and institutions realize that growth was built on fragile foundations rather than sustainable fundamentals. Once confidence breaks, the system shifts quickly from expansion to contraction. This transition is rarely gradual because financial systems operate on trust and expectations rather than physical assets. When those expectations change, liquidity disappears almost instantly. The result is a chain reaction of falling asset prices, tightening credit, and increasing defaults across sectors. This process has repeated itself across multiple economic cycles throughout history. One of the clearest examples occurred during the Great Depression, which followed a decade of rapid credit expansion and speculation. Investors believed that economic growth would continue indefinitely without interruption. By 1929, borrowing to invest in the stock market had reached extreme levels, with margin debt fueling speculative behavior. When prices began to fall, forced selling accelerated the collapse beyond control. Between 1929 and 1933, the U.S. economy contracted dramatically as output fell and unemployment surged above 20%. The financial system experienced widespread failure as thousands of banks collapsed. Savings were wiped out, businesses closed, and confidence in the economic system deteriorated rapidly. The crisis spread globally, affecting economies far beyond the United States. Policy decisions at the time worsened the situation instead of stabilizing it. Monetary tightening reduced liquidity when the system needed support the most. The gold standard limited the ability of central banks to expand the money supply quickly. This rigidity amplified deflation and increased the real burden of debt. As prices declined, debt became harder to repay, leading to more defaults and further economic contraction. This created a self-reinforcing downward spiral. The lesson from this period is that excessive debt combined with inflexible policy can turn a downturn into a prolonged collapse. Timing and adaptability are critical in preventing systemic failure. A different but equally important pattern emerged in the 1970s after the Bretton Woods system collapse, which ended the gold-backed monetary system. This allowed governments to expand the money supply more freely. Throughout the decade, inflation rose sharply, eroding purchasing power and destabilizing economies. By 1980, inflation in the United States exceeded 13%. To restore stability, Paul Volcker implemented aggressive interest rate increases. Rates rose above 15%, triggering a recession but ultimately controlling inflation. This period demonstrated how monetary expansion can lead to inflationary crises if not managed carefully. The cost of correcting such imbalances is often severe. Japan's economic bubble in the late 1980s followed another variation of the same pattern driven by easy credit and rising asset prices. Real estate and stock valuations reached extreme levels disconnected from economic reality. By 1989, the Nikkei index peaked near 39,000, reflecting unsustainable optimism across markets. The system depended heavily on continued credit expansion. When interest rates increased, the bubble burst and asset prices collapsed sharply. Japan entered a prolonged period of stagnation known as the Lost Decade. This experience showed that recovery from a credit-driven collapse can take many years, even in advanced economies. Structural imbalances take time to correct. Today, global debt has reached levels never seen before, exceeding $300 trillion across all sectors. This represents a significant increase compared to previous decades. Interest rates remained historically low for years following the 2008 crisis, encouraging borrowing across the global economy. This created conditions similar to previous expansion phases. Governments increased spending significantly during the COVID-19 pandemic to support economic activity. This resulted in large fiscal deficits and rising debt levels. Central banks responded with quantitative easing, injecting liquidity into financial markets by purchasing assets. This supported asset prices and economic stability in the short term. However, this liquidity also contributed to rising inflation in later years as money supply expanded rapidly. The effects became visible in 2021 and 2022. Inflation reached levels not seen in decades, forcing central banks to change their approach. Monetary policy shifted from expansion to tightening. Interest rates began to rise rapidly to control inflation and stabilize the economy. This created new pressures on borrowers and financial institutions. Higher borrowing costs increased the risk of defaults, particularly in highly leveraged sectors. This exposes weaknesses that were previously hidden. At the same time, global supply chain disruptions and geopolitical tensions added additional stress to the system. These factors complicate economic stability. Currency dynamics also play a critical role in shaping financial outcomes. The dominance of the US dollar remains central to the global system. Historically, reserve currencies have changed over time as economic power shifts between nations. The transition from the British pound to the dollar is one example. Such transitions often occur gradually but can accelerate during periods of crisis. Confidence in a currency is the key factor that determines its strength. If confidence weakens, capital flows can reverse quickly, leading to currency depreciation. This increases the cost of imports and fuels inflation. Emerging markets are particularly vulnerable due to their reliance on foreign-denominated debt. Currency weakness increases their debt burden. This creates a cycle where debt and currency instability reinforce each other. The system becomes more fragile over time. Large investors and billionaires often respond to these risks by adjusting their strategies early. Their focus shifts from growth to preservation of wealth. Historically, this includes increasing exposure to real assets such as commodities, land, and infrastructure. These assets tend to retain value during inflationary periods. Diversification across multiple currencies and regions is another key strategy. This reduces exposure to any single economic system. Investment in essential sectors like energy and food production provides additional stability. These sectors remain resilient during downturns. These actions are not based on speculation, but on historical patterns and data. They reflect an understanding of economic cycles. The concept of smart money refers to investors who act before trends become obvious to the broader market. Their movements often signal underlying risk. Early warning indicators include tightening credit conditions and declining liquidity. These signals have appeared before previous downturns. Today, similar indicators are emerging across global financial systems. This suggests a transition phase may already be underway. However, outcomes are not predetermined and depend on policy decisions and external factors. Governments still have tools to manage crises. These tools include fiscal stimulus and monetary intervention, which can stabilize markets temporarily. However, overuse can create long-term risks. Excessive intervention can lead to inflation and currency instability if not carefully managed. Balancing these factors is complex. The global financial system is highly interconnected, meaning problems in one region can spread quickly. This increases systemic risk. Technological advancements have accelerated market reactions, making financial systems more responsive but also more volatile. Information spreads instantly. Despite these changes, human behavior remains a constant factor in economic cycles. Fear and greed continue to drive decision-making. This ensures that financial cycles repeat over time, even as the details change. Patterns remain consistent. The implications of current trends include potential volatility and slower economic growth. These outcomes align with historical patterns. Debt restructuring may become necessary in some cases, where repayment is no longer sustainable. This process can be disruptive. Inflation may persist if monetary policy cannot fully control it. This erodes purchasing power over time. Currency fluctuations may increase, affecting global trade and investment flows. Exchange rates become more unstable. Financial institutions may face pressure if asset values decline significantly. This can lead to tighter lending conditions. Consumers may reduce spending due to rising costs and uncertainty. This impacts economic growth. Businesses may delay investment decisions in uncertain environments. Confidence plays a central role. However, crises also create opportunities for reform and structural improvement. Weaknesses become visible and can be addressed. Historically, major financial crises have led to regulatory changes and new economic policies. These shape future systems. The challenge is ensuring that reforms address root causes rather than symptoms. Poor solutions can create new risks. Understanding these patterns allows individuals and institutions to prepare for potential outcomes. Awareness reduces vulnerability. The idea of a secret plan is not about hidden conspiracies, but about strategic positioning based on known risks. It is grounded in data. Large investors have access to resources and analysis that allow them to act earlier. This provides an advantage. However, the patterns they follow are visible to anyone who studies economic history carefully. The information is not hidden. Economic cycles are structured processes influenced by policy decisions and human behavior. They are not random events. This makes them partially predictable, providing a framework for understanding future developments. Patterns repeat with variation. The coming years may test the resilience of the global financial system under current conditions. Multiple pressures are building simultaneously. Policy decisions, geopolitical developments, and market responses will determine the outcome. Each factor interacts with the others. Financial systems are adaptive and evolve in response to challenges over time. This adaptability can prevent collapse, but also create new risks. The balance between stability and growth is delicate and requires careful management. Missteps can have large consequences. The most important insight is that economic instability often builds gradually before becoming visible. By the time it is obvious, it is often too late to react effectively. The actions of billionaires are not based on fear, but on recognition of these patterns. They position themselves accordingly. The real question is not whether a financial shift is coming, but whether individuals understand the signals early enough to respond. Awareness is the difference between reaction and preparation. In the end, the system is not controlled by hidden forces, but shaped by decisions, incentives, and behavior over time. Those who understand this structure are better equipped to navigate uncertainty. The coming financial shift, if it occurs, will not be unprecedented, but another chapter in a repeating cycle. The pattern has already been written many times before. And the final reality is this: the greatest advantage is not wealth or access, but understanding how the system truly works beneath the surface. Because once you see the pattern clearly, the future becomes less uncertain and far more predictable.